If you're working towards or already in retirement, you might be wondering, how the heck do people not only get to the lowest tax bracket, but how do they pay $0 in taxes during retirement? I'm telling you right now, you don't need any exotic tax strategies to do it. You don't need any crazy investments to get it done. Today, we're going to break down how you can get there and how it might be more realistic than you realize. And we're going to tie it all together at the end with a case study. I promise you, you don't want to miss today's episode. Welcome back, guys. If it's your first time here, be sure to hit that like and subscribe button so you can keep getting content just like this. And of course, if you need help with your own financial plan, reach out to us at www.modernwealth.com. That's modern, spelled with no vowels, wealth.com. We'd love to help you out. All right, guys. So in order to get your head around this, there are a couple different rules that you need to be aware of. If you're aware of how these rules work, then it's easier to not only see how paying $0 in taxes in retirement is possible, but also how it might be more doable than you realize. So the first thing you need to be aware of is how Social Security is taxed. Social Security is going to be the biggest component of a lot of retirees' income strategy. And depending on how much income you have in retirement from other sources, anywhere from 0% to 85% of your Social Security benefit is going to be included in your taxable income. Now, the key word here is included. Say it with me again, included. A lot of people think that Social Security can be taxed at a rate up to 85%, but that's flat out incorrect. Depending on how much provisional income you have, that's going to dictate how much of your Social Security benefit you are going to have to report as taxable. So the $1 million question is, how do you determine how much provisional income you have? And how you do that is you're going to take all your gross income. So that's going to be your wages, any pension income you get, taxable interest your portfolio generates, IRA distributions, taxable rental income, all of that. You're going to add it all up. Next, if you for some reason have municipal bond interest in your portfolio, that needs to be added back in. And finally, you're going to take half your Social Security benefit and add it to the equation. So if you get $35,000 a year in Social Security income, take that number and cut it in half and add it back into your provisional income. So in this case, $17,500 gets added back to your provisional income. So if you take a look here and assume you're married and the only source of income you have is Social Security of $35,000 a year, that means your provisional income is half that number, which is $17,500. And that means that 0% of your Social Security benefit would have to be reported as taxable income. However, let's say that you add $5,000 from portfolio interest and you get another $12,000 a year from an old pension that you have. Now our provisional income is $34,500. We're technically in that 50% provisional tax bracket. However, the provisional tax system is a progressive system, meaning that the first $32,000 of provisional income gets excluded from taxable income. However, we're $2,500 over that 0% threshold. That doesn't mean that half of our Social Security benefit is now taxable. Instead, only $1,250 of our Social Security benefit is considered taxable. And that's because we're going to take $34,500, subtract it from $32,000. That gives us $2,500. We're now going to take half of that number, which is $1,250. And that, ladies and gentlemen, is how much of our Social Security in this example would have to be reported as taxable income. That's less than 4% of our Social Security benefit is considered taxable here. Now, the reason why this is so important to understand is that you probably have more flexibility than you realize to take Social Security and also draw income from other sources and even deploy strategies like Roth conversions and keep the majority of your Social Security benefit as untaxable. The next rule that you need to be aware of that will come in handy is the increased standard deduction you get once you hit 65. So, as a refresher, in 2025, the standard deduction is $30,000 if you are married and $15,000 if you're single. However, once you hit 65, that standard deduction goes up to $33,200 and $17,000 if you're single. Now, you're going to see in a second here that if you're strategic with your taxable distributions, when you take Social Security, heck, even how much capital gains you incur, that standard deduction could be enough to drive your taxable income down to $0. Finally, one of the biggest tools on your tax tool belt is going to be taking advantage of 0% long-term capital gains. Now, most people, if you ask them, how much is long-term capital gains tax? They're going to say, oh, well, that's easy, JB. The answer is 15%. And yes, if your taxable income is over $48,000 as a single filer and about $97,000 as a couple filing a joint return, then yes, your long-term capital gains rate is 15%. However, remember these long-term capital gains brackets are based on what your taxable income is. That means you're going to take your gross income in retirement and subtract that big old standard deduction from that figure, and that's how you determine what your taxable income is. And hopefully it's hitting you that if you play your cards right, you can actually incur a decent amount of income and long-term capital gains and still pay $0 in taxes. So let's tie this all together and see how this could happen. So first, let's take a look at our imaginary clients for this example. This is Homer and Marge Sample. They are both 67, they are retired, and they each get $2,750 a month in Social Security benefits. Marge also gets $1,000 a month from an old pension. Their balance sheet is pretty solid. They each have $750,000 in their own pre-tax traditional IRAs. They have $125,000 in the bank, and Marge has $200,000 chilling in a Roth. Finally, Homer has a low basis stock in his portfolio that if he were to sell, he would incur long-term capital gains on. Now, here is what they want to accomplish. They want to live off $8,000 a month, and they want to do it completely tax-free. Now, you might be looking at someone worth nearly $2 million in liquid assets and pretty solid Social Security benefits and thinking that there's absolutely no way they're going to be able to pull that off. But let's see what happens. All right, guys, so let's go ahead and see if we can pull this off, get their income up to $8,000 a month and not have any federal tax liability. So let's look at their current situation as it stands right now, because I think this is going to really drive the point home with everything that you've learned today. So before we make any modifications, they're generating about just shy of $7,000 a month in income. And how we figure that out, we go ahead and see that there's some taxable interest being generated from that savings account. There's a little bit of dividend income coming in there. Obviously, we talked about that pension, that monthly pension coming in for $12K, and then we combine their Social Security on an annual basis, that's $66,000. We add all of that up, and we're just shy of $7K a month in income that we're generating. But keep in mind, right, the goal is to get it up to $8K a month. So we're going to have to generate a little bit more income. But the reason why I want to show you this is that if we look at how things stand right now, their taxable income is, as it is right now, is to the point where they're not paying any federal taxes. And the reason why that's the case, despite them having all this income, is, remember, only a sliver of that Social Security is considered taxable. And the reason for that is that when we add up their provisional income, and you do the math based off those provisional income brackets, we're in a position where only $11,100 of their Social Security is considered taxable. So if we keep going down their hypothetical tax return here, their total income is $28,100. And that big old standard deduction of $33,200 that we talked about earlier completely wipes that all out. And the end result is taxable income is zero, their effective tax rate is zero, and they pay no federal taxes. But if we bump that up, right? If we bump their monthly income to $8K a month, are we going to incur tax? Well, let's be a little strategic here and let's make it happen. All right, guys. So if you take a look here on scenario 2, this is everything is the same here. Okay. We didn't change anything dramatic on their income statement. So they still have taxable interest. They still have those dividends creeping into the portfolio. They have the pension, Social Security is all the same. However, this is what we did to generate the extra 1K a month that they need. So this is a two-part move that we did. Part one is we decided to take a total of $6,000 from Marge's Roth IRA that she has. So we took 6K out of that Roth IRA, and that gets us halfway there, right? We need a total 1K a month or $12,000 in additional income. So 6K from that Roth gets us halfway there. And the money from the Roth is completely tax-free, doesn't get baked into the provisional income equation. It's a thing of beauty. So we tapped the Roth. The next thing that we decided to do, we decided to trim that stock position, and we raised $6,000 in cash from that particular stock position with the low basis on the balance sheet. Now, when we did that, we incurred $5,700 worth of long-term capital gains. Okay, so we got our 6K. So the 6K from that sale and the 6K from the Roth money gets us the 12K in additional income that we needed to hit their goal. But are we going to incur federal income tax? Remember, they told us don't want to incur any federal income tax. So $5,700 in long-term capital gains, that gets added to the provisional income equation. So now we're in a position where our taxable Social Security that we have to report, that goes up. So because that goes up, are we going to pay federal income tax? Well, let's find out. We keep going. Our total income is $38,645. $38,645. Our standard deduction, $33,200. So taxable income, $5,400. It's looking like we're going to have to pay federal income tax here. Oh, take a look. Zero, big fat zero right there. So we accomplished the goal. We got them the additional income that they needed and kept their total tax to zero. Now, how the heck did we do that? Well, remember, the money that we took out of the Roth, that's completely tax-free. So that portion is easy to understand. But the $5,700 in long-term capital gains that we incurred, remember, if your taxable income, if you're filing a joint return, is less than 98K, just about 98K in 2025, then your long-term capital gains rate is 0%. 0%. And that is how we were able to completely avoid paying any taxes despite increasing the capital gains that we took and increasing the income that we absorbed into the portfolio. It's a thing of beauty there, guys. So there you have it, guys. That is how it's possible to pay $0 in taxes in retirement. Obviously, everyone's situations, balance sheets, incomes, all of that is going to be unique. But you can see if you play your cards right and take advantage of different elements of the tax code, you can bring that rate down to zero. Now, realistically, for our clients today, one question that I would want to explore is, well, that's nice having, a 0% tax rate, but are we simply deferring taxes later down the road in this example, right? I mean, we have to worry about RMDs down the road. Does it actually make sense to incur a little bit of tax this year so that in the future, we also can experience low tax years, right? That's something that I would want to explore here. And it's something else that we'll explore in future years, right? Threading that needle between, yes, chasing a low tax situation now and making a sacrifice so that when we look at our long-term tax rate in retirement, it's all smoothed out and relatively low. Something we'll explore in future episodes. If you guys like today's content, be sure to like and subscribe. And of course, if you need help just like this, reach out to us at www.modernwealth.com. That's modern spelled with no vowels, wealth.com. I hope you enjoyed it, guys, and I'll see you next time.